What if I told you that most people lose thousands of dollars just trying to buy a car? And it's not their fault. Dealerships have mastered the art of confusing you with shiny deals and low monthly payments, all while stacking the deck in their favor. The real question is, are you falling into their trap? Whether you're planning to buy, lease, or finance, the truth is shocking, and it's costing you more than you think. In this video, we'll break down the 4 main ways to get a car and reveal the strategy that can actually save you thousands. Stick with me, because by the end, you'll know the best way to buy or lease a car. Let's get started. Part 1, the 4 ways to own or drive a car. When it comes to getting a car, there are 4 main options, and each one comes with pros and cons. First, financing or hire purchase. This is a popular choice for many. Here's how it works. You pay a down payment and finance the rest through a loan. Over a term of 3 to 5 years, you pay monthly installments plus interest. At the end of the term, you fully own the car. Second, leasing. Think of leasing as long-term renting. You pay a monthly fee to use the car for a set time, usually 2 to 3 years. Monthly payments are lower because you're only covering the car's depreciation during the lease period, plus some fees. However, at the end, you don't own anything. You hand the car back. Third, personal contract purchase. PCP. PCP is a hybrid of leasing and financing. You pay a down payment, make monthly payments, and at the end of the term, you have 3 options. Return the car, pay a large balloon payment to keep it, or use the car's value as credit toward a new deal. Dealerships love pushing this option. Fourth, buying outright. This one's straightforward. You pay the full cost of the car up front, and it's all yours. No monthly payments, no strings attached. Just you and your new ride. The car is 100% yours from day one. But which way is worth it for you? Let's break it down. Part 2, crunching the numbers. To make this fair, we'll use the same benchmark. A mid-size Honda Civic priced at $25,000 with a $3,000 down payment and a 3-year term. Let's see how the numbers stack up. Option 1, financing. With financing, your monthly payments depend on the loan's interest rate. Assuming an interest rate of 10%, your monthly payment would be roughly $700. Over 3 years, you'll pay $25,200 in total, including interest. At the end of the term, you own the car outright. If you sell it for $15,000 after 3 years, your net cost of ownership is $10,200. Option 2, leasing. Leasing comes with lower monthly payments since you're only covering depreciation. With a $3,000 down payment and $400 monthly payments, the total over 3 years is $17,400. But at the end, you walk away with nothing. You don't own the car. Option 3, PCP. For PCP, let's assume monthly payments of $450. Over 3 years, your total payments are $19,200. To keep the car, you'll need to pay a balloon payment of $12,000. If you return the car instead, you're out $19,200 with nothing to show for it. Option 4, buying outright. If you buy the car outright for $25,000 and sell it for $15,000 after 3 years, your net cost is $10,000. However, the opportunity cost of tying up $25,000 in one purchase needs consideration. Part 3, lifestyle and psychological factors. The numbers don't tell the whole story. Your decision depends on your lifestyle and mindset. If you're someone who likes to own what you drive and keep your car for years, buying outright or financing makes sense. You'll eventually pay it off and eliminate monthly payments, giving you more freedom in the long run. However, owning a car comes with increasing maintenance costs as it ages. Think new tires, brakes, and unexpected repairs. On the other hand, if you value driving a new car every few years, leasing or PCP might be a better fit. Leasing offers the lowest monthly payments and eliminates the headache of selling your car later. PCP gives you more flexibility at the end of the term, allowing you to keep the car or trade it in for something new. Your financial situation matters too. If you have a solid emergency fund and no high-interest debt, buying outright can be a smart move. But if you're still building your savings, financing or leasing allows you to drive a car without draining your bank account upfront. Part 4, what dealerships don't want you to know. Dealerships often push PCP for one simple reason. It's highly profitable for them. The low monthly payments make it seem like a great deal, but the balloon payment at the end often catches people off guard. Many end up rolling that payment into a new PCP deal, trapping themselves in a cycle of never-ending payments. Leasing contracts can also come with hidden fees. Exceeding mileage limits or returning the car with scratches and dents can lead to hefty charges. Always read the fine print and factor these costs into your decision. Another trick dealerships use is dealer contributions. They might lower your deposit or offer incentives to make PCP look more attractive. But remember, dealerships are businesses. Their goal is to maximize their profit, not necessarily save you money. So at the end, what's the best option for buy or lease a new car? The answer depends on your priorities. If you want the lowest overall cost and have the cash up front, buying outright is the way to go. If you prioritize lower monthly payments and don't mind not owning the car, leasing is worth considering. If flexibility at the end of the term is important to you, PCP might be a good choice, but only if you've done the math. If you're looking for a balance between affordability and ownership, financing can be a solid middle ground. No matter what, the key is to run the numbers based on your specific situation. Don't rely solely on what the dealership recommends. Take control of your finances and make an informed decision. If this video helped clarify things, share it with someone who's considering their next car purchase. Let me know in the comments what your next car plan is. Thanks for watching, and I'll see you in the next video.